Smart Finance Moves, Insight from CS and IP.
Welcome back to IPO Insider. In today's video, we're diving deep into the risks associated with investing in IPOs. While IPOs can offer exciting opportunities, they also come with significant volatility and other potential pitfalls. Whether you're a seasoned investor or a newbie, understanding these risks will help you make more informed decisions. Let's break down the key risks and provide real-world examples so you can navigate the IPO market with confidence. One of the primary risks investors face when buying into an IPO is market risk. IPOs are often priced based on market conditions at the time of launch, and they can be subject to high volatility once they start trading. IPO stocks are often subject to rapid price fluctuations in the initial days or weeks of trading. This is partly because the stock may be overhyped before it lists, leading to inflated demand that doesn't always align with the company's long-term performance. Additionally, market sentiment plays a huge role. If the broader market is facing uncertainty or downturns, newly listed stocks tend to be more vulnerable. Investors might rush to sell, leading to price drops, or conversely, they might scramble to buy, pushing the price up temporarily. This volatility can make IPOs risky for investors looking for stability. Another significant risk in IPO investing is overvaluation. IPOs can sometimes be priced too high either due to market hype or overly optimistic growth projections. When companies go public, their valuation is often a reflection of their perceived potential rather than their current earnings or profitability. If an IPO is overvalued, the stock may open at a premium but fail to live up to expectations, causing the price to drop below the offering price. Many investors get caught up in the excitement and speculate on the stock's short-term price movements rather than focusing on the company's fundamentals. This speculative nature can lead to inflated prices and eventual corrections. One of the most talked about examples of overvaluation in recent IPO history is Paytm. Paytm's IPO in 2021 was priced at a hefty valuation of $20 billion, but despite the hype surrounding the digital payments giant, its stock price fell significantly after the listing. Many investors and analysts questioned whether the valuation was justified, given the company's lack of profitability at the time. This case highlights the risk of overpaying for a company that's still figuring out its financial footing, especially when the market overestimates its future growth. While some IPOs skyrocket after listing, others fall flat or even fail to meet initial expectations. These failures can be due to a variety of factors, including overvaluation, poor market conditions, or fundamental weaknesses in the company's business model. Snapchat's IPO debut was one of the most highly anticipated in recent years, but its stock struggled after listing. Despite initial excitement, concerns about user growth, competition from Instagram, and profitability issues caused the stock to decline. Although WeWork never officially went public, its IPO attempt serves as a textbook example of how high valuations can lead to failure. The company's business model, corporate governance issues, and unsustainable growth projections led to a collapse in its valuation. Investors, wary of these factors, saw the IPO fail to launch, and the company had to rethink its strategy. These examples show that IPOs are not always a guaranteed path to profits. Even well-known companies can struggle to live up to expectations, and investors may face significant losses if they buy in without fully assessing the risks. As an investor, there are several ways you can reduce the risks associated with IPO investments. Don't rely on hype. Study the company's financials, business model, and management team. Make sure the IPO is reasonably priced compared to its earnings and growth potential. Don't put all your money into a single IPO. Spread your investments across different asset classes. Just because an IPO is getting attention doesn't mean it's the right investment for you. Make sure it fits within your long-term financial goals. IPOs tend to perform better in certain market conditions, so keep an eye on broader market trends before investing. IPOs can be a thrilling way to invest, but they also come with risks that every investor should understand. From market volatility to overvaluation, these risks can lead to significant losses if not approached carefully. By researching the company, assessing the valuation, and managing your expectations, you can increase your chances of success when investing in IPOs. If you found this video helpful and want to continue enhancing your investment knowledge, make sure to subscribe to our channel and hit the notification bell so you don't miss any updates. Stay tuned for our next videos. Thank you for watching and happy investing.